I'm joined now for some analysis by James Knightley, a senior economist at ING Financial Markets, and it looks like the overall rate of unemployment, James, poised to rise.
Yeah, I think there's two stories going on in today's report. One, you've actually got the jobs market improving. All the demand indicators are pointing to a rise in payrolls. We're getting something around the 175,000 mark. But the problem is the unemployment rate. It's been very, very volatile. Last month, if you remember, we saw a very significant drop from 9.8% to 9.4%. Now, that reflected two big moves in what are a very volatile series, the household survey of employment and the size of the labour force. Now, the labour force shrunk and the household survey showed a big rise in jobs. Now, that's very volatile. We'd suggest that if the labour market truly is improving, then perhaps that's going to encourage more people into the labour force, and that's going to mean the unemployment rate is probably going to remain quite elevated for some time. So we see a bit of a risk that it moves slightly higher today towards 9.6%.
What about the long-term unemployed, structural unemployment? How much is that weighing on this overall rate?
Well, it is. I mean, we've seen the severe downturn, and a lot of people have lost jobs, and the longer they're out of the labour market, then they lose skills, and that makes it much harder for them to re-enter the labour market. But, of course, we've got to remember that the workforce is constantly growing in the US very rapidly, so you've constantly got a new supply of highly skilled labour coming in. So, in terms of that aspect, I think, structurally, the longer the people are out of work, then that makes it more difficult. But, in general, we'd suggest that the growth in the economy is really picking up. It's being felt across all the surveys, and importantly, the household consumer confidence surveys are showing an improvement in the labour market as well. So if that's happening, then I think we can be pretty confident that the consumer fundamentals are on a better path.
And yet Fed Chairman Bernanke is saying, look, we've got to continue our purchase of treasuries. We've had some positive signs so far, but guess what? Recovery is a long way from being established because this recovery in the labour market not happening fast enough.
Yeah, it is disappointingly slow, but I think, we're getting a mini fiscal stimulus right now, we're getting tax cuts and an extension of unemployment benefits, and that should support consumer spending. And at the time, if the labour market is improving, albeit gradually, then that should help confidence and spending as well. So we'd still be pretty confident that the US recovery story is on track.
And yet we have this situation, these two forces at work that you were describing, that you have new people coming to the market, so you have more of a demand for jobs, more people coming to the market. At the same time, you've got the long-term unemployed, these two things contributing to the rate and unemployment rising. What needs to happen to turn this around? I mean, we're talking about how long before we see a dip below 9% in overall unemployment?
Well, I think it could be some time. We're suggesting it's going to be probably next year before we do actually see a conclusive break below the 9% level. I think, the activity story is improving. We've had that in the ISM data this week. Next week, we get the National Federation of Independent Businesses. That's the small business sector of the economy, and that's half the US economy. And that's been really lagging behind. Now, credit conditions are improving, and if the demand in the aggregate in the US is improving, then we're hopeful that that small business sector can really start growing strongly, and that's where we're going to really start to see the job creation over the next couple of years.
James Knightley from ING, thanks so much for putting that into context for us. Thank you.